So we've covered a lot of ground so far, but we're still not ready to start trading yet. So even though we've covered topics like the history of money, the Forex market, quotations, Forex terminology, like pips, lots, leverage, short selling, we talked about brokers, we talked about technical analysis, like charts, trends, candlestick patterns, chart patterns, technical indicators, how we use fundamental analysis and economic calendars, platforms. We're still not ready to place a trade yet because the most important topic of them all is the one we're going to cover now, which is risk management. And if you guys look at any private investment firm and you go online and see what type of jobs or careers they offer, you're going to see a lot of job postings for risk managers. Why? Because this is the most important thing. Managing risk. You are going to see some analyst positions, but you're not going to see, profit-taking management. These companies don't focus on how much money they're making. They focus on how to minimize the risk. Because ultimately, by minimizing risk and minimizing how much money you could lose, you kind of maximize how much money you'll be making in the long run. So this being said, you have to understand that without proper risk management, even if you understand everything else, you will not be successful in trading. So what is risk management exactly? And what is even risk? So risk is basically just an action or an activity that has a potential to go wrong. And when you think about it this way, you'll realize that everything you do in life involves risk, right? If you want to jump off an airplane and skydive, well, there's risk. You could die, right? But you perceive that the risk associated with that activity is so small that it's worth it, right? The probability that it materializes is small and the gain that you get out of it is worth it. If you want to go to, Mexico for vacation, then there's risk. The plane you're on could crash and you could die, but it's a small risk. You perceive it as a small risk and you're willing to take that risk for the outcome or for the benefit. If you get married, there is risk. If you have a kid, there is risk. If you drive to work, there is risk. There's risk in everything. And your job is to see if the risk is worth it or not. And then if you can minimize that risk in any way possible, you have to do so. And this is the objective of this lecture. So risk management is basically going to be the action of figuring out what the risk is and then seeing what you're going to do with it. Now, you have several risk management techniques, 4 of them to be specific. The first one is risk acceptance. And risk acceptance is when you see that there's a risk and you just say, okay, well, you know what? I'm willing to take that risk and I'll take all of it, right? So this is something that we're never going to do in trading, because in trading, when you're just accepting risk, that means that you're willing to buy a currency at this price. And if it goes completely the other way and it goes, to zero, then you're willing to take all that risk and you're willing to lose everything you have, which we're never going to do. Okay. So risk acceptance is never something we're going to do. And an example of this would be basically like looking at USD CAD and saying, you know what, I'm going to buy it at $1.34 and that's it. If it goes down all the way to 40 cents or 30 cents or 20 or 1 cent, I'm still holding. That's it. I accept the risk. We're never going to do that. The second thing is risk avoidance. Risk avoidance is when you see something and you perceive that the risk is too high. And you say, you know what? I'm just not going to partake in this activity because the risk is too high. I'm just not going to do it. And I'll walk away from that. And this is something we will do in trading. Example, when we're looking at the economic calendar and we're seeing that there's an event happening. So we just don't want to have a position throughout this event because it's too much risk. We don't know what's going to happen. We don't want to take that risk. This is something that we'll do. The third risk management technique is the one that's the most popular and the one that will do the most, which is risk limitation. So you perceive that there's a risk and you want to limit the loss if that risk materializes, so you don't lose too much. And this is done through stop losses, which we'll talk about more in the next lecture. But this is really what we're going to be focusing on, is limiting our risk. And in this situation, if we're looking at a currency like USD CAD and we think it's going up and we buy it at 134, then we might say, you know what? If it doesn't go our way and it doesn't go up and it starts going down, well, I'm going to limit my risk and I'm going to take a loss. And I'll take a loss at 1.32 or 1.30 or 1.28 or 29, whatever it is. I'm going to limit my loss. If it goes against me after a certain point, I'm going to take my loss and I'll move on and to another trade. And that's it. That way I limit my loss and the maximum amount I could lose is quantified and I'm okay with it, right? And this is what we're going to be doing the most, okay? The fourth risk management technique is risk transference. Risk transference is basically when you give the risk to somebody else. It's like when you buy insurance for your house. You know that when you buy insurance, you're paying a bit more than what it's actually worth because the company makes money off of you, but you're willing to do that because you're scared that, you lose your house. Now in trading, we don't do that. We don't, you can buy options, you can buy different things to transfer the risk to another party, but then you'll be paying a premium for it and you'll be losing in the long term. When we're trading, we're willing to accept small amounts of risk and get paid for them a bigger amount of money. But if we transfer that risk and we pay for it a bigger amount, then we're not making money in the long term. So again, this is not something we do. The only two things we're going to be doing is going to be risk avoidance and mostly is going to be risk limitation. Okay. And this is what we're going to be looking at in the next lecture.